Howdy out there, folks. It's Darius Dale here to present our macro minute for Tuesday, May 3rd, 2022. Starting with markets, we have stocks mixed this morning with U.S. equities lagging, commodities down, crypto up, dollar down, global bond yields down. Market moving headlines, you had the RBA came out and surprised market and economist consensus expectations with a 25 basis point rate hike to 0.35%. These numbers are so small. That number is bigger than expected, and it's the first time we've seen a 25 basis point rate hike in 12 years. Governor Philip Lowe said more rate hikes are needed. They also outlined the outlined the outlook for their balance sheet. Effectively going to maintain the current level. They won't buy new assets, but they're not going to do quantitative tightening either. And he obviously said that what central bankers need to say in these moments, which is we're not on a preset course, da 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 da. But obviously, if inflation continues to surprise to the upside in Australia, they will continue to hike rates. We'll unpack a lot of the Australian grid model dynamics in our leadoff morning note today for those of you who care on either the Aussie dollar or Aussie equities. Lots going on from a reflation standpoint in terms of commodity demand and where we are in the commodity cycle. Just checking in on global bonds. Australia's 3-year yield top 3% for the first time since 2014. A lot of milestones, including the U.S. market. Yet the 10-year yield hit 3% on Monday. Germany's benchmark rate, 10-year, rose above 1% for the first time since 2015. So again, a lot of milestones to the downside in bond prices across global fixed income markets, as fixed income, in our estimation, continues to price in a more significant reduction in global monetary liquidity relative to where risk assets are pricing. You continue to see new highs in OIS forwards across the curve in Europe, US, places like Australia, whereas you're not necessarily seeing new lows in risk assets. So there's some reconciliation to be done there in either direction. Obviously, it's no guarantee that the bond market is right, but we believe the bond market is right. More so than the risk assets, because again, where we are in the growth cycle and the liquidity cycle. Just kind of one thing I flag, yet BP shares, they climbed, they announced a 2.5 billion buyback as cash flow is surging. So continues to see signs of global energy producers not really ramping up production. It doesn't make sense to ramp up production, obviously, with China on lockdown at this particular moment. They're going to come out of lockdown, obviously, at some point in the next month or two. And so that may be a signal to increase production. We'll certainly get an increase in crude oil and other commodity demand when that occurs. And then lastly, from a deglobalization standpoint, I think this is one of the key themes of 2022 and beyond. You had Italian Prime Minister Mario Draghi. He's called for a swift rethink of European Union mechanisms to allow the bloc to face quote unquote unprecedented challenges linked to Russia's invasion of Ukraine and soaring energy prices. So you're going to, as I mentioned, the fiscal response and the regulatory response in Europe continues to be something that is changing very quickly and changing in a major way in sort of in a direction that promotes deglobalization. It's more cohesion within Europe, but more deglobalization, multipolar world, et cetera, as it relates to Asia, Russia, et cetera. So lots going on from a geopolitical risk perspective. But as I tweeted this morning, this is not your event volatility, Fed pivots dovish, and then everything's off to the races again type of year. This is a year where you have a rolling series of negative macro catalysts that are catalyzing leaky outflows from risk assets, and obviously not so leaky, very large outflows from bond markets globally. And this is a destruction of capital taking place that is leaving investors with not many places to hide. So we continue to preach the value of cash in this particular juncture. Big movers this morning. Bloomberg Industrial Metals Index off 1.6% to minus 9.5% month over month. WTI crude oil down 1.3%, but still up about 6.1% month over month, still maintaining that positive trend. Getting into the VAMs, the volatility adjusted momentum signal and probable range. For the major macro markets here, U.S. dollar still bullish, VAMs ragingly bullish. You got minus 2.3% of downside to the lower boundary of its probable range versus 0.5% of upside. Gold looks like it's trying to break down here. It's actually getting pretty close to our price signal line that would trigger a bearish VAMs phase transition. So we'll keep watching this very closely week to date and throughout this week. So, but it's obviously at the lower boundary of its probable range with 6.3% upside. So kind of studying the bounce, if we get one over the next week or two, will be pretty instrumental on gold, but clearly looking like it wants to try to break down here. 10-year nominal treasury yield, bullish VAMs with minus 22 basis points, fair fight, minus 22 basis points of downside versus 22 basis points of upside in its probable range. High yield OAS, neutral VAMs still at the upper boundary of its probable range of 57 basis points of downside. S&P 500, that is bearish VAMs with minus 3.6% of downside versus 6.5% of upside. VIX still neutral VAMs for now, with minus 40% of downside versus 6% of upside. NASDAQ 100 bearish VAMs with minus 6.4% of downside and 7.4% of upside. Russell 2000 bearish VAMs minus 4.4% of downside versus 7% of upside. Bitcoin, Ethereum still both bearish VAMs. Bitcoin's got minus 9% of downside versus 7% of upside, so somewhat of a fair fight in its probable range. Same deal with Ethereum, minus 10% of downside versus 8% of upside. Shanghai Composite still closed here, bearish VAMs, minus 5.1% of downside versus 4% of upside. WTI crude oil neutral VAM still on this trend line here. If it breaks down immediately below the trend line, it's telling you that we're getting into demand destruction phase, but I don't believe we're there yet. In fact, once we see China come back online from a demand signaling perspective with respect to the lockdowns, you might actually get a push higher in crude oil and energy commodities. So be aware of that. Don't get short oil here. You would much prefer to see oil shorting oil after that catalyst occurs if we don't see a big pickup in price. Obviously, we're not preaching the virtues of being short oil, but I know there's a growing contingency on FinTwit that's getting bearish on commodities. And I certainly believe that from an industrial metal standpoint, that should be breaking down, just given where we are in the global growth cycle. It's a lot more sensitive to demand, to growth, than the other pockets of the commodity markets, the physical commodity markets. But yeah, we're still oversold here with 10.2% upside. And then lastly, ag, neutral VAMs with minus 1.5% of downside versus 4.5% of upside. So with that, Darius Dale presenting our macro minute for Tuesday, May 3rd, 2022. Best of luck out there today.